Welcome. In this lecture, we will study debt, equity, and the effects of financial leverage. This is an important topic because every firm must answer a basic financing question. How should the assets of the firm be financed? A company may use internally generated cash flow. It may borrow from lenders. It may issue bonds. It may issue new shares. It may also use hybrid securities that combine features of debt and equity. The choice among these financing sources is called the capital structure decision. This decision matters because it determines how the cash flows produced by the firm's assets are divided among different investors. It also affects required payments, financial flexibility, exposure to financial distress, managerial incentives, and control arrangements. A useful way to begin is to separate the investment decision from the financing decision. The investment decision asks what assets the firm should own. The financing decision asks how those assets should be financed. Capital structure analysis focuses on financing, but financing cannot be evaluated in isolation. Firms with stable cash flows and tangible assets can usually support more debt than firms with volatile cash flows, intangible assets, and uncertain future investment needs. So today, our goal is to understand not only what debt and equity are, but also how they change risk, return, control, and managerial decision-making. Let's begin with the basic difference between debt and equity financing. Debt financing means the firm raises capital by promising fixed or scheduled payments to lenders. These payments usually include interest and principal. Debt holders have a contractual claim against the firm. That word, contractual, is very important. If the firm cannot make required payments, creditors may have legal remedies. They may renegotiate the terms of the loan. They may restrict the firm's actions. In severe cases, they may force default proceedings. Equity financing is different. Equity holders are owners. They receive a residual claim on the firm's cash flows. This means they are paid after contractual obligations have been satisfied. Common shareholders usually receive voting rights, participate in upside gains, and bear much of the downside risk. The central distinction is fixed claims versus residual claims. Debt has higher priority. Equity has lower priority. Debt payments are generally required. Dividends and share repurchases for common equity are generally discretionary. Debt holders usually have limited upside. Equity holders participate in value creation after fixed claims are paid. Debt can be less flexible because the firm must make required payments even when operating performance is weak. Equity is more flexible because payments to common shareholders can usually be reduced or suspended. But issuing equity can dilute existing ownership and affect control. So debt and equity are not simply different ways to raise cash. They create different claims, different rights, different risks, and different incentives. Let's now think about the firm as a system for producing and allocating cash flows. A firm's operating assets generate cash flows. Those cash flows must then be distributed among different claimants. Some claimants are connected to operations. Employees must be paid. Suppliers must be paid. Governments may collect taxes. Lenders may receive interest and principal. Preferred shareholders may have preferred claims. Common shareholders receive what remains. For common shareholders, the key concept is the residual claim. After operating costs, taxes, interest, principal payments, and other contractual obligations have been satisfied, the remaining cash flow belongs economically to the owners. This gives equity an asymmetric payoff pattern. If the firm performs poorly, common shareholders may receive little or nothing. If the firm performs very well, common shareholders receive most of the additional value after fixed claims are paid. Debt holders have a different payoff pattern. Standard debt holders normally receive the promised payments if the firm has enough cash to pay them. If the firm is extremely successful, they usually do not receive additional upside beyond the promised payments. But if the firm performs badly, they may bear losses through default, restructuring, or bankruptcy. Control rights also differ. Equity holders usually have formal voting rights. Creditors usually influence decisions through covenants. A covenant is a contractual restriction or requirement in a debt agreement. Covenants may limit additional borrowing, restrict asset sales, require minimum financial performance, or constrain dividends and repurchases. As leverage rises, these control rights become more important because creditors become more concerned that shareholders and managers may take actions that transfer value away from lenders. Before we discuss leverage, we need to separate business risk from financial risk. Business risk is the uncertainty in the operating income generated by the firm's assets before we consider how they are financed. It comes from the business itself. Demand may change, prices may fall, competition may increase, technology may shift, input costs may rise, customers may become more concentrated. The firm's operating strategy may succeed or fail. These are operating forces. They exist even if the firm uses no debt at all. Financial risk is different. Financial risk is the additional risk borne by equity holders because the firm uses fixed financing obligations, such as debt. When debt is present, a portion of operating income must be paid to creditors before shareholders receive anything. This makes shareholder returns more sensitive to changes in operating performance. The key lesson is this: financing choices do not remove business risk, they redistribute risk among the firm's claimants. A firm can have high business risk and low financial risk if it uses very little debt. Another firm can have moderate business risk and high financial risk if it uses substantial debt. For shareholders, the combined risk depends on both the volatility of operating income and the amount of fixed financing obligations. This distinction is extremely useful. When we analyze a firm, we should not say simply, "This company is risky." We should ask, "Is the risk coming from the assets, from the financing, or from both?" The word leverage means using fixed costs or fixed obligations to magnify changes in outcomes. In finance, we often discuss operating leverage and financial leverage. Operating leverage arises when the firm has fixed operating costs. These may include rent, salaried labor, equipment depreciation, software infrastructure, or long-term supply commitments. When fixed operating costs are high, a change in sales can create a larger change in operating income. This is because fixed operating costs do not automatically rise and fall with sales in the short run. Once those costs are covered, additional sales can contribute strongly to operating income. But when sales fall, fixed costs remain, and operating income can decline sharply. So operating leverage is not about debt. It is about the cost structure of the business. The degree of operating leverage, shown in the background visual, measures how sensitive operating income is to changes in sales. Operating leverage affects the path from sales to operating income. A firm with high operating leverage may benefit greatly when sales grow, but it may also suffer greatly when sales decline. That is why operating leverage is closely related to the firm's business model. It tells us how strongly operations respond to changes in revenue. Before managers add financial leverage, they should first understand the operating leverage already built into the business. Financial leverage arises when the firm uses debt or other fixed financing obligations. Operating leverage affects the movement from sales to operating income. Financial leverage affects the movement from operating income to net income, earnings per share, and return on equity. The reason is simple. Interest and other fixed financing payments must be handled before common shareholders receive the residual income. When financial leverage is high, even a modest change in operating income can produce a larger change in shareholder results. The degree of financial leverage, shown in the background visual, captures this sensitivity. It asks, when operating income changes, how strongly do earnings available to shareholders change? As operating income gets closer to required interest payments, financial leverage becomes more powerful and more dangerous. This is why highly levered firms can experience sharp changes in earnings per share and return on equity even when operating income moves only modestly. Debt can provide benefits. It can avoid ownership dilution. It can impose discipline on managers. It can sometimes lower financing costs. But debt also creates required payments, refinancing risk, covenant restrictions, and potential financial distress. So financial leverage should never be evaluated only under normal or optimistic conditions. It must also be evaluated under weak operating conditions. Let's now connect leverage to return on equity. Return on equity measures income available to common shareholders relative to common equity. Debt can increase return on equity when the firm earns more on its assets than it pays on its debt. The intuition is straightforward. If borrowed funds help support assets that earn more than the borrowing cost, the surplus accrues to shareholders. This is the positive side of leverage. But the same mechanism works in the opposite direction. If the firm earns less on its assets than it pays on its debt, leverage reduces return on equity. Leverage raises return on equity when operating returns are strong relative to borrowing costs. Leverage lowers return on equity when operating returns are weak relative to borrowing costs. And in both cases, leverage makes return on equity more sensitive. This brings us to a very important distinction. Higher expected return on equity does not automatically mean value creation. Leverage can increase expected shareholder returns by increasing shareholder risk. When equity becomes riskier, investors generally require a higher expected return. So managers must ask whether the higher expected return is enough to compensate investors for the additional risk. That is why leverage is not free value, it is a trade-off. Managers often compare financing plans by looking at earnings per share. Earnings per share connects income available to common shareholders with the number of common shares outstanding. Debt financing can raise earnings per share for a simple reason. If the firm borrows instead of issuing shares, it avoids increasing the share count. If the earnings generated by the financed assets are strong enough relative to interest expense, the remaining shareholders may receive higher earnings per share. But debt can also lower earnings per share when operating income is weak. Interest must be paid before income is available to common shareholders. This fixed payment can reduce or eliminate the benefit of having fewer shares outstanding. This is where break-even analysis becomes useful. The EPS break-even point is the level of operating income at which alternative financing plans produce the same earnings per share. Above that point, the debt plan may produce higher earnings per share. Below that point, the equity plan may produce higher earnings per share. At the break-even point, the earnings per share are the same. This analysis is useful, but it is incomplete. It does not show the probability of different operating outcomes. It does not show the consequences of financial distress. It does not fully capture the effect on the cost of capital. It does not measure the value of preserving borrowing capacity for future opportunities. So EPS is helpful, but it is not the final answer. Earnings per share is an accounting measure, not a direct measure of value creation. Financial leverage magnifies gains and losses for shareholders. This happens because debt holders have a prior claim. Interest must be paid before earnings are available to common shareholders. When operating performance is strong, fixed debt payments leave more residual income for equity holders. When operating performance is weak, fixed debt payments absorb a larger portion of operating income, and shareholders bear the decline more sharply. This is the magnification effect. The practical lesson is clear. Debt is most attractive when operating cash flows are stable enough to support required payments even under adverse conditions. Debt becomes dangerous when managers evaluate it only under normal forecasts or optimistic forecasts. A common misunderstanding is that a firm should use debt simply because debt can raise expected return on equity or earnings per share. That reasoning is incomplete. The financing decision changes the distribution of returns. It does not automatically improve the firm's assets, customers, products, technology, or competitive position. A firm's total value is divided between debt holders and equity holders. Capital structure determines how that value is split. Whether total firm value changes depends on broader issues such as taxes, financial distress costs, agency problems, information effects, transaction costs, and market frictions. The mechanical effects of leverage are the foundation, but value creation requires a deeper analysis than simply observing that shareholder returns may be higher in favorable states. Let's finish with the managerial interpretation of leverage. Leverage is not inherently good or bad. Its usefulness depends on the firm's assets, cash flow stability, investment opportunities, tax position, financial flexibility, and risk tolerance. Managers should ask several practical questions. Can the firm meet interest and principal payments in a weak operating environment? How cyclical are revenues and margins? Are there tangible assets that can support borrowing or be sold without destroying the business? Will the firm need capital for future projects, acquisitions, or working capital? Could the firm be forced to refinance during unfavorable credit market conditions? Would covenants restrict operating or strategic choices? Could high leverage weaken relationships with suppliers, customers, employees, or regulators? Could debt discipline managers, or could it encourage excessive risk taking? A conservative capital structure may reduce expected return on equity, but preserve flexibility. An aggressive capital structure may raise expected return on equity, but increase the probability of distress. The right financing policy is not the one with the highest earnings per share in a spreadsheet. It is the one that supports the firm's strategy while keeping risk at a level investors and stakeholders can bear. The most common mistakes are treating higher earnings per share as proof of value creation, ignoring downside scenarios, confusing business risk with financial risk, assuming debt capacity is permanent, and forgetting strategic flexibility. A careful leverage analysis combines calculations with judgment. The numbers show how leverage changes return on equity, earnings per share, and sensitivity to operating performance. Managerial judgment decides whether the added risk is acceptable. Thank you for watching. I will see you in the next video.